Unless you have had your head in the sand or have been living underneath a rock, you've probably noticed that we are in the grip of a full-blown banking crisis. Now, over the past couple of months, there have been insolvencies, receiverships, or liquidity injections at banks including Silvergate, Silicon Valley Bank, and First Republic Bank. And the demand for gold and silver has also spiked among new and old investors. Concerned about a full-blown banking crisis, the Federal Reserve has agreed to backstop all deposits, at least as of this video, and has created a new program called the Bank Term Funding Program. In the new program, banks can pledge collateral at face value rather than market value, which is substantially less to obtain liquidity and maintain solvency. If banks were forced to sell their treasury holdings in the market, as Silicon Valley Bank did, they would receive a fraction of what they would have if they held their bonds to maturity. The reason for this is that if they purchased their treasury bonds at significantly lower yields due to the higher yields, now the only way to incentivize a buyer to acquire the bonds is to offer them at a discount. Bank runs have been caused by concerns within our banking system, at least among the smaller and regional banks. If the FDIC becomes insolvent, individuals will lose deposits exceeding $250,000 and may lose their entire savings if their bank becomes insolvent. As the FDIC only has assets of $125 billion to insure against a potential exposure of $9 trillion, these concerns are valid. Individuals are liquidating their bank accounts and seeking safe haven investments because of these concerns, among others. Historically, gold and silver have been among the most popular asset classes when investors become concerned about systematic risk, such as what we are currently experiencing in the financial service sector. Gold and silver are not only becoming more popular among long-term investors, but many individuals are investing in them for the first time as well. In order to help you navigate some of the unknowns in this often overlooked asset class, we thought we would take a moment to provide 3 important points when investing in gold and silver. Investing in gold and silver should not be seen as a short-term strategy. Physical gold and silver investments are often viewed as a means to preserve wealth, a safe haven investment, a way to hedge against financial and economic crises, and a way to protect oneself against a waste-thrift government and a central bank that prints money on a regular basis. You should not use it for speculation or to make quick money, as they say. In light of our financial situation, which includes the highest inflation rate in 40 years, considering the federal debt is close to $32 trillion, annual deficits are over $1 trillion, mass layoffs have already begun, and the dollar is under threat of declining as the world reserve's currency, it's safe to assume that gold and silver prices will eventually rise. Now, rather than paying much attention to the spot price, we recommend that you focus on the physical price. In conclusion, if all the dealers you contact online or locally are selling gold and silver coins at a high premium, there must be a reason. In the future, you may measure your wealth in ounces of gold and silver rather than dollars, according to precious metals broker Bill Holter. Another quick note regarding physical gold and silver prices. A few months ago, a year ago, or even a week ago, you may have been able to purchase gold and silver coins at a different price than today. Markets are constantly changing due to supply and demand. It's just like any other industry or sector. Prices will rise when demand exceeds supply. You shouldn't discount gold and silver coins outright just because your coin dealer asks you to pay a higher premium than you have in the past. It is not possible to trade gold and silver at the spot price. First-time buyers often assume that gold and silver coins and bullion can be purchased at the prevailing spot price published on financial websites. Newcomers to the industry should know that spot price for gold and silver, or for that matter, any precious metal, is the per ounce price. When you purchase a coin that is in high demand, liquid, and widely traded, you should expect to pay more than the spot price. As a result, coins like American Gold and Silver Eagles, American Gold Buffaloes, 90% silver coins, and Morgan and Peace silver dollars will trade for more than their underlying precious metals value. Premiums can vary widely based on supply and demand in the market. When you purchase these coins, you'll pay more than the spot or melt value. Investors who have traditionally invested in digital investments such as mutual funds and ETFs might find this surprising. Physical gold and silver markets, however, are quite different from electronic ones. The first is that ETFs and mutual funds do not allow you to settle or redeem in physical gold or silver. Additionally, these investments are often highly levered, which means there isn't enough physical gold and silver to fully back the number of shares or contracts. Now, these paper investments could actually go to zero. A physical coin differs from a digital share in that it costs money to, mine, extract, refine, fabricate it. Furthermore, refiners, mints, wholesales, and retailers must be compensated for their time and effort. In addition, retailers with a lot of inventory are taking a lot of risk when it comes to market fluctuations. Buy gold and silver coins when you can, not when prices fall. It doesn't necessarily take 8-figure investments for the physical gold and silver market to dry up. Gold and silver are estimated to be owned by about 10% of the population, but even then most people likely have limited holdings. Our best guess is that only about 1% of the population owns a substantial amount of gold and silver. Now, there would be a strain on the market if the number of investors doubled from 1% to 2%. Increasing it to 5% would likely result in very little inventory remaining. All it would take is simply a few whales to make 8 or 9-figure investments, and inventory would just vanish. Now, it is not our intention to incite panic or fear by sharing this information. Please be aware that inventory is not always available in this relatively small market. So therefore, having gold and silver on hand is better than not having it, even if you have to pay a higher premium for it. As a hedge for what's coming down the pike, you should consider moving some of your holdings into gold and silver coins or bullion as soon as possible.